This is principally just the same provisions, the same act, which were earlier guiding us. Principally, there is not much that changes, especially not for the common people. We don't have the rules, which is quite a substantive part of the law, because there is quite a lot of things that depend on the rules. So all of that will be introduced and will be put in place in the next couple of months.
Can we put all this together as a old wine in a new bottle? That is what happened in today's budget. From burying a 65-year-old tax law to fundamentally changing how we look at our earnings, Union Budget 2026 is less about new tax slabs and more about a complete operating system upgrade for the Indian taxpayer. With the brand new Income Tax Act of 2025 set to kick in this April, the government is promising a clean slate, replacing the confusing assessment year with a simple tax year and turning share buybacks into a win for the small investor. But is this just a cosmetic change or a true revolution in the ease of doing business? Hi, this is Abhirami Sekar for the Federal, and today we are decoding the fine print of these historic direct tax reforms. Joining us to break this down is Ashish Mehta, partner at the Kaitan and Co. Ashish is a seasoned expert in both domestic and international taxation, with a specialized niche in direct tax litigation and offshore asset investigations. Ashish, welcome to the show.
Thank you so much.
Ashish, we have lived with the 1961 Act for over 60 years. In terms of daily compliance, what is the single biggest pain point that 2025 Act actually removes for an ordinary citizen?
Actually, as people have been portraying it as, this is principally just the same provisions, the same act, which were earlier guiding us into a new law. What they have really done is they have reduced a lot of cross-referencing. They have simplified language. They have also kind of included all the similar placed language, or relevant language in one section, rather than one having to flip 4 5 pages here and there, go to one section and then read amendment in some other section, and all of that sorts. So basically, what they've done is they've condensed the law, and they have made it easier and user friendly. So the biggest benefit, or what is the biggest benefit here, is that there is clarity, and there is interpretational guidance, which was earlier lacking. Also, like it took us many years to come to the present position. So they've kind of incorporated all that experience from court matters, from the litigation that has been seen, and they've put it together in one law. So basically, that's what they've done. Principally, there is not much that changes, especially not for the common people. Of course, we as professionals will have to kind of remember quite a lot of things, learn, unlearn. Quite a lot of things will happen for professionals, and in-house tax consultants or tax employees. But yeah, not too many changes really. Nothing to be worried about.
For decades, Indians have struggled with the concept that they earn in the previous year but file in the assessment year. Why was this distinction kept for so long, and how does moving to a single tax year simplify the filing interface?
Confusion of assessment year versus previous year, pay challans for the wrong years, pay taxes for the wrong years, filings are made for the wrong years, etc. So yeah, I think it's only a progressive step that we converge these two concepts into a single year. Again, it'll be a little difficult for people to kind of immediately, because they've been used to this for a good, a lot of people for their entire life. So now they'll have to then redo or undo whatever they've learned in the past, and just start using just one year as a concept. So yes, this is a progressive step, following a lot of other countries as well. So yeah, hopefully it'll maybe again, I think in the overall scheme of things, maybe it'll be a little confusing at the start, but the end goal with which this is introduced is quite good, because now there will you don't need to remember 2 2 3 3 years. You just need to remember one relevant period, and that's about it.
Will this change how we pay advance tax or how we calculate TDS? Does the tax year align us with the global standards like the US or UK?
Yes, this is the global standard. Mostly, a lot of countries are adopting or have already adopted a concept of the tax year, which is the single year where you pay as well as assess in the same year. So yes, and in terms of your next question on does it change anything as far as advanced taxes or payment of TDS or anything is concerned? No. The provisions principally remain the same in the new law as well. So you will pay quarterly advance taxes, or as you are required to, as far as capital gains, etc., are concerned, in the year in which you earn that income. Also, the TDS provisions, what they've really done is there are too many rates that are applicable today under the old law. They've tried to consolidate all of that and like just have a couple of rates for TDS deduction. So they've in those terms really simplified what one needs to be careful of. But yeah, in principle, no change in your advanced tax requirements, in your TDS compliance requirements. They continue the way they were in the old law.
How will the tax department handle the transition period between the old AY or PY system and the new tax year system? Is there any risk of double taxation or missed reporting during the crossover?
Hopefully not, because we do have quite a robust online mechanism in place where there is an income tax portal, and which kind of uh, everything is now online. So it's not a paper or physical thing where you're dependent on some officer's understanding of a certain change, or a change happening at the systems phase as well. So basically, this is all there is a central processing center where all these changes will automatically be incorporated into the tax systems and into the tax profiles of the taxpayers. So I and anyways, there is like as far as we are concerned, till the time 31st March 2026 comes, you're very clear that your tax return needs to be filed under the old act come 1 April 2026. And this was clarified today by the finance minister as well, that the law, the implementation of the new law will be from today, from 1st April 2026. So the moment you come into 1 April 2026 and you start earning income in that year, then it's the new law which is going to be applicable to you. So there is no, hopefully there should be no overlap or double counting, especially because everything is system based, and I'm sure they would have made sure, and anyways they have 2 more months to kind of introduce all the rules, introduce all the laws, put them in public domain, seek comments, clarifications, etc., and then introduce the law ultimately, even the rules, because as we speak, although the law is there, we don't have the rules, which is quite a substantive part of the law, because there is quite a lot of things that depend on the rules. So all of that will be introduced and will be put in place in the next couple of months. So there is going to be a lot of action, at least as far as tax laws are concerned, for the next 2 months, because there will be a lot of consultations happening. There'll be a lot of presentations happening to the government. Then those will be incorporated, and a full law will be introduced with the rules, with all the relevant forms, etc. That's all yet to come.
Previously, buybacks were often treated like dividends, which was expensive for those in high tax slabs. By moving to a capital gains model, how much tax leakage is a retail investor saving on average?
Maybe I can just quickly tell you what a buyback is, where and we've seen quite a lot of changes in the provisions of buyback. So basically, a buyback is a situation where if there is a company which has excess funds, and it thinks that, okay, fine, I want to reward my shareholders. What I'll do is I will buy back certain shares from the market and cancel them. And generally a buyback price would be a little or maybe a lot higher than what the market price, what the prevailing market price, to incentivize the taxpayers to kind of, or the to incentivize the investors to kind of tender their shares in the buyback. So traditionally, we've seen quite a lot of changes in the buyback provisions. There used to be a time when buyback was taxed in the hands of the company that was buying back the shares. Uh, and there were a certain deeming provisions where tax was deducted on the basis of the buyback price minus the price on which the shares were issued by the company at some point in time. Then, as you said, we moved to another regime where buyback was taxed as income from other sources, as dividend in the hands of the investor. So what happened was the buyback, whatever was the buyback proceed, was treated as a dividend and taxed as income from other sources. So if an individual is in the highest tax slab, he would end up paying 35-36% of tax on the amount that was received as a buyback on the gross basis. And then whatever cost he had purchased those, like the shares, he would have purchased them for some cost. That cost would be available as a capital loss to the assessee. So basically, you end up paying tax on the entire consideration that you receive. You don't reduce the cost of the shares. You That is available to you as a separate head, as a loss. So of course, if you have other capital gains to set off that loss, it's okay. But otherwise, this used to be a leakage in the hands of the investor, because you'd end up paying tax on the entire consideration that you received and get no benefit, so to say, immediate benefit, because of course you can roll over the capital gains loss and you can claim it in the future years as well if you filed a return in time. But basically, that was the anomaly that was happening.
The budget introduces an additional buyback tax for promoters, 22 to 30%. Is this effective? The government saying reward your small shareholders, but don't use this as a tax free exit for yourselves.
Yes, they have kind of made it a little uh, difficult for the promoters also to participate in the buyback, because at least as far as tax is concerned, they end up paying more taxes. Of course, 22% for a corporate promoter and 30% for all the other categories of promoters. So basically, what they've done is they've made it a little difficult for the promoters to kind of use the buyback route to exit shares. But that's how it is, because anyways, you compare it with the immediately previous regime, maybe it might be better for the promoters, because at least in that immediately previous regime, you were paying uh, as dividend, on the entire amount as dividend, and you were getting a capital loss for the capital. So in terms of an immediate compare with the previous provision, maybe this is a better step. Of course, this will need to be seen in more detail as to how, what is it that the fine line, and what is it that the promoters really kind of look at it, and how is it looked at by the promoters. But yes, at least as far as there is an intended differentiation that they've done between the normal investors and a promoter as far as buyback tax is concerned.
Should investors now prefer cash rich companies like IT majors that do frequent buybacks over those that pay high dividends?
Your investment decision should not really be dependent only on buyback versus dividend. Of course, there are quite a lot of other factors which might influence that decision. But yeah, everything retained and everything being the same, uh, whether a buyback or a dividend paying company, what would you choose from? It would really depend on what your income composition is. Yeah, maybe if you've participated in a recent buyback and you have those capital losses available to you because of some other buyback which would have happened in the recent regime, you might prefer a buyback, because at least whatever gains you in the next exit, whatever gains you make, that will be treated as buyback, and again it will be on the real income that you're earning. So it's a trade-off. It's like one will need to kind of, I don't think investment decisions can just be made on the basis of whether a company is paying more dividend or whether a company is paying more, buy more, or buying back more shares. So and they have a decent number, like your income up to 12 lakh 75,000 is exempt. So that's quite a decent number as far as a lot of employees are concerned.
The finance minister promised redesigned forms. As someone who sees these forms daily, do you believe we are heading toward a future where a salaried individual can file the return in under 10 minutes without a CA?
So yes, I think in terms of simplification, yes, chances are that for somebody opting for a new scheme who has no investments, who has no deductions to claim, it is possible that you don't need professional help to file tax returns. But that's not the case for everyone. So it'll again depend on what your profile is, what your incomes are, if you are having capital gains, if you have investments into various other assets like cryptocurrencies, etc. So all of that, you'll then have to take a holistic picture on whether you need professional help or not. But yes, their objective is clear. They want to make filings very easy. They want to make everything at the tip of a button, and you can kind of just see what's happening and what are the implications, etc. But complete uh, removal of say professional help for filing tax returns is still some time away. I would think it's not going to be immediate. So yes, in principle, expectations are always there. Nothing for the tax, like nothing for the individual taxpayers in this budget really, because no change in slab rates, no major changes, anything else, no deductions, etc. So, yeah, in principle, there have been changes quite a lot, but yeah, mostly on expected lines, not something not very outrageous has happened in the budget.
Yes, got it. So, can we put all this together as a old wine in a new bottle? That is what happened in today's budget.
Yes, you're right. That's how this budget, or maybe not even this budget. Actually, the law was introduced a little while earlier. The 2025 Act was introduced some time back. But yes, in principle, yes, it's what it is. But I think initial years, there's going to be a lot of confusion, maybe a little bit of if and buts here and there. But gradually, I think we will settle down, and hopefully, this law will be administered as well as interpreted in a much better way than the old one.